Well, lots to digest in the government's response to the Murray inquiry. And with me now in the studio is Roger Montgomery from Montgomery Asset Management. Roger, welcome. Can I start with you, though, on the banks? Is this pretty much what the banks expected?
Well, they've raised, as you know, about $20 billion in anticipation of this being enshrined. What's been observed is that 90% of household lending has been provided by the banks, and 65 to 70% of their exposure is to domestic lending. So the banks need to be unquestionably strong, quote unquote, and perhaps stronger than their peers overseas. And so the requirement to raise capital and to reduce the amount that they can leverage that capital makes perfect sense. But at the same time, it's a couple of nails in the coffin for property prices in Australia.
Well, the Prime Minister today, I think, said there's no reason for the banks to follow Westpac and put up rates. But even the inquiry, the Murray inquiry itself, acknowledged that raising this capital has a cost. Well, that cost inevitably will go to the customer, won't it?
Never take investment advice from a politician. That's the first thing. But what you've got to remember is that the banks have taken a 40% hit on the profitability of their mortgages just from the changes to the mortgage risk weighting ratios. They've got to recoup that because in the long run, share price performance is determined by intrinsic value, which is driven by return on equity. So raising equity and lowering profits reduces your return on equity. They are trying to recoup that. But in so doing, and at the same time, remember, APRA has said we want you to limit growth on investor loans to 10%. So you've got a lot of nails in the coffin now for property prices. And I believe that we've seen the peak. So this is going to be a real problem for credit growth and therefore bank profits. And a lot of retirees have, well, up to 40% of their superannuation in bank shares. And
the way their wings have been clipped, I suppose, the big banks, is the credit card fees in terms of excessive fees.
Exactly. And so on many fronts, the fields of lavender that or clover that the banks have enjoyed over the last, I guess, 10 years or thereabouts, it's over. It's over now.
You talk about the knock to shareholders and possibly the dividend policies we might see change, but of course the other side of it is the customer.
The dividend policy may not change, but the dividend reinvestment plans, you might find those underwritten in order to raise more capital if that's required. The customer will suffer because on the one hand their mortgage rates will go up, and the depositors will also suffer because they'll lower. The pressure will be on banks to lower interest rates on term deposits, again, to boost profits.
So do you think the pain is going to be shared between the shareholders and the customers, or will it be weighted to one?
It'll be weighted towards shareholders, but the returns of the past won't be repeated in the future, which makes Gail Kelly's reverse pike back in November look prescient.
That was good timing, wasn't
Exactly,
it?
Indeed.
All right, look, just on super, presumably this is really what many in business have been hoping for. How dramatic are these changes, and perhaps is that an opportunity for banks to get in on this default super?
Absolutely. I think the bigger change is the potential mandating of income products through this, because what's actually happened is previously superannuation was defined as required to provide retirement benefits, which was ill-defined, and now it's been enshrined, or it will be enshrined in legislation, that it's to produce retirement income. And what we need is more retirement income products and more certainty, because retirees are underspending. They don't know how long their money will last.
Very interesting future for retirees.
Indeed.
Roger Montgomery, thank you very much for joining us.
Thanks, Ticky.